Okay, so we're going to get this meeting started off here. Welcome, everybody, and thank you for joining. All right, so we're going to talk about covered calls today. We're going to talk about the principles of covered calls. So it's just a really great strategy to start using. If you currently have a portfolio of stocks that are just sitting there, maybe they're paying you a dividend. Maybe those stocks don't pay a dividend. Maybe you just earned on the positive gain, hopefully, that stock has generated you. Generally, you're probably holding on to it for a long period of time, and um, you probably don't want to sell the stock, but hopefully you want to generate a little bit more revenue. So the covered call is an option strategy that allows you to do that, and it's very basic. It's very simple, and it is the entry level option strategy for a lot of people to get into selling options. So let's talk about some of the principles here. So the underlying asset. Let me switch up my pen here. So the underlying asset is secured. So you already own the stock. You have to own at least 100 shares. A stock option is a minimum of 100 shares. Um, so you already own the stock. You maybe have been assigned stock. So some people deploy a more advanced strategy of covered calls, and that is the covered call wheel, or the wheel of covered calls. It's the wheel strategy is another way people say it. It's pretty awesome. I got into it myself. I'm currently on the second step of a wheel strategy for three different stocks that I own. So the wheel strategy, the way it starts is that you sell naked puts essentially against a security that you want to buy at a cheaper price, and you'll sell those puts over and over again. You generally at the monthly time frame. You sell the put, you collect a premium, and then if the stock goes against you, if the stock goes down, then your put contract is going to rise. So you're shorting the put contract price. So if the put contract price rises, it's going against you, and your deltas are getting higher. And so eventually, if at the week of expiration you are in the money, you're at risk of being assigned those stocks. The stocks are going to get put to you, and so those puts, the contracts that end up getting put to you, if the price does rise above your strike, your broker will then assign those shares to you from the person that bought the contract from you. So now you own 100, 200, 300 shares of a company. Then the day that you put those shares, or the day after, which generally is a Monday because you're going to be assigned on a Friday. On that Monday, you'll immediately sell a covered call. So now you have 100, 200, 300 shares, and now you can sell a covered call against those shares, and continue to collect a premium. And that's what we're going to talk about today. And then the other way to receive these underlying assets is that you bought the stock, believing it would go up over a long period of time. So you're a long-term investor, which is a great thing. So we want to we want to continue with that mentality. Long-term investing is the right way to go. We can use short-term principles and avenues to generate a little bit of revenue. So the next time that a market crash happens, or the market is selling at a premium, you can buy in, and it's a great way to just generate a little cash for your account. So the second principle would be dividend enhancement. So not every stock generates a dividend. A lot of them do, and a lot of people buy into dividend generating stocks for that revenue. And so one thing that a covered call can do is that it can take a dividend that is maybe 1.5% yearly, 1.5% return, and enhance it to 10, 15, 20% in some cases, depending on the security. Um, and it can significantly increase your returns. And it's the same with a stock that doesn't generate a dividend. You're just earning on the value of the stock. Then you can generate a revenue and generate your own synthetic dividend essentially. Um, let's see. Yep, that's everything about the dividend enhancement. And so what's the risk and reward essentially? So the reward is, you're hedging downward moves in the stock that you own. So in a bear market, a covered call strategy is going to offset some of the losses that you're taking in your portfolio. If you like a delta neutral portfolio, covered calls can help you in that aspect. Doing buying a 100 shares gives you 100 deltas, and then shorting those 100 shares can give you about half of that back. So depending on the day and how those option contracts are priced and how they're moving. So you can offset some of that and kind of bring your portfolio closer to neutral if that's what you're trying to do. And in the same right, you're still taking a profit, even in a down market. So where some people may be taking 5, 10, 15% losses on their portfolios, this covered call strategy is going to buffer some of that, and maybe you're only going to take a 6, 7% annualized hit to your account because you're generating this income. So the risk, if you're not doing the wheel strategy, you could be selling some of your shares lower if a large upward move was to happen. And so we can mitigate that by just not trading the months that your company has a earnings report, or if your expiration is coming up and there's a big news catalyst that could affect your stock price, in actually a positive way. You could just avoid trading that option contract for that month. Now, if you're stuck and you already have an option contract, and there's a news catalyst that happens and it benefits your company that you currently own, we're probably not going to be selling all of the contracts, and so even if you did have your stocks called away, you still will gain a bit of benefit. Hopefully you have bought the stock at a lower price than your strike that you are selling your covered calls at. So, and we're going to look at all that. It will make a lot more sense once we get into the platform. So, all right. So, when to use the covered call strategy. So, you'll want to use the strategy, after you've accumulated over 100 shares of stock that you like. The stock has a low dividend. Stock has no dividend. You want to own the shares for less money. So one benefit to the covered call strategy is that it allows you to reduce your essentially your the amount of and the word is of course it's escaping me at the moment. I have to look that up because that's going to bother me if I don't. Let's see if I have a note with that on here. Yeah, I thought I did. The word I'm looking for is escaping me, so we'll just continue on. Basis. That's the word I was looking for. So you can it will help you reduce your basis. So let's get back to where we were at. Okay, so if you want to sell the shares at a guaranteed higher price than you bought them at, so generally we will be selling calls at a higher strike price than the cost that we purchased those shares at. So you can sell at a higher price or at a lower price if you want to, but um, I would be absolutely sure that the stock was taking a pretty good downturn because you don't want to get caught selling those option contracts at a lower price that you bought them at. So you're not incurring that negative loss um, and because you won't be able to offset that with the amount of premium that you're collecting. So something to be cognizant about. And you don't have to trade it all the time. So, just take your pick and choose the scenarios because even just trading a covered call 3 times a year is going to enhance your return and it's going to make your portfolio look really nice. So we'll look at some strategies to generate. So move this out of the way. So how does the security you own does the security you own trade more than 1 million shares per day? So liquidity is really what we're looking for. We want to make sure that we'll be able to buy in and sell out of an option contract fairly easily within 5, 10, 15, 20 minutes. So uh, uh, generally securities that are trading less than 1 million shares a day have a minimized option ladder. There's not if there's 1 million shares of liquidity being traded in a stock, maybe there's only 15,000 contracts being traded in a day, or less, or it could be a lot less. It could be 500 contracts being traded in a day. So we want to be careful with the liquidity of the stock because you will get stuck with a contract that you cannot sell. And if you're in a position where you're taking quite a bit of a loss because of a huge upward move, well, I mean, you're going to have to take that on. So, do you own more than 100 shares? So, a minimum requirement. Are you comfortable selling the portion or all of these shares? So, hopefully, you own more than 100 shares. If you don't, it's perfectly fine. I like this strategy to generate income to buy more shares. So, I have definitely done that. I will take the profits of um, the a couple of months of option selling and I will use those profits to buy more shares of the company that I'm doing the covered call strategy on. So it's a great way to build a position in a company that you like. Selling puts as well. So I mean, you can do both at the same time if you have enough equity in your account. Are you comfortable selling a portion or all of the shares? So if you want to go all in, absolutely. It's a guaranteed way to generate a profit above the price that you bought your stocks. Just know that if there's a huge upward move, you may be risking losing some of that upside. So it's just something to consider. Is the price of the stock greater than $5 to $10? So anything under $5 is considered a penny stock anymore. I would not trade any securities that are under or at a risk of going under $5. So just keep it safe and trade in securities that are $10 and greater. If you're buying into a security that is a to do a stock to do a covered call strategy essentially. And then what is the monthly and quarterly yield of your position? So monthly and quarterly yield is essentially how much you make off that security every month and or quarter or yearly. Because then what we can do is we can take the percentage that we have gained off of the covered call strategy and add that directly to your monthly and quarterly yield that you are currently receiving. So, all right, I think that's enough of the presentation. Yep, that's it. So let's take a look at some live strategies, and I've set one up for us here to kind of take a look at. So, all right, great. Okay, so the platform I like to use is Thinkorswim. It is just my favorite platform. I've tried a couple other ones. This one is by far was the easiest for me to learn, and has a very powerful trade platform for stocks and how everything's displayed. If you want some help, I can absolutely walk you through learning the TD Ameritrade Thinkorswim platform if you decide that that is the broker that you'd like to take. Every broker has gives you the ability, essentially all the large brokers give you the ability to trade option contracts. You do in most cases have to request options trading. It may not be a default that has been given to you when you opened your account. So another thing you will want to know are that there are multiple levels of options that you can gain access to. So option level 1 will give you very basic, I believe covered calls are about one of the only things you could do, and selling puts. You may be able to do both. And then the second level gives you a cash secured margin account, essentially. So your own cash in the account can be used as margin against, trading into larger positions, doing more call selling and put buying. So. And then level 3, TD Ameritrade has level 2 positions. One is cash secured, and then the other one is pure margin. If you have greater than $2,000 in your account, the TD Ameritrade does give you access to their own margin. In some cases, you do have to apply to it. So there's multiple different ways of going about it. And then the level 3 is essentially selling naked options. So naked options are essentially mostly traded on margin. They're required to have margin because you do have unlimited risk. So if you are doing a straddle or a strangle, you can have unlimited downside risk, and it can go pretty quickly. So the nice thing about it is, if you want to call it that way, the brokers actually have a way of doing a margin call. So if you're not available to watch your account and you have a naked straddle or strangle on, or just a naked, if you bought a call or sold a put, and it's the security has gone against you, essentially TD Ameritrade will sell the position or buy it back, and then they can also use stock in your account or cash to cover whatever the margin was, whatever that difference was. So it is incredibly important that you make sure that if you do decide to use margin, that you're using it safely and you're only using very small amounts. So, okay, so there's my rant on margin. Next thing we're going to look at. So I took a look at Oracle has some interesting ability for being a good covered call stock to do a covered call. So the way we looked at this is that I went back around the beginning of the year. They had this very large gap down, so they were trading up around in the $53 range. And then around in March, they gapped down to about $46 after an earnings call. So the market was pretty much trading sideways for a little while. Not a whole lot of upward or downward movement, this is actually a prime place for covered call selling, because maybe you bought your stock back here and you've lost some money. Maybe you bought into this dip. So one thing you'll want to do is that, hey, you're not making very much money in this choppy accumulation phase that's going on here. So one thing you can do while this is happening is, while you're selling those covered calls, you're building a return on your portfolio, even though the security itself hasn't risen and you haven't seen realized any value out of it yet. So, but remember, we're long-term holding. So the fact that maybe Oracle hasn't gone anywhere in 2018, it's just not a big deal. You're looking at holding on to Oracle for the next 10, 15 years because you believe that maybe they'll be worth $100. So, but this is where we're at right now. So what we can do is we can look at these monthly contract expirations. So each line on the screen here is the end of a monthly contract. So since we are going to start doing our options selling, we're selling right after after an earnings call. So we've got a good 3 months of contracts that we can sell without being at risk of a weird move in the price just because of a quarterly call. And so actually Oracle is really good for a different strategy, but we won't talk about that this time. There's a really cool strategy you can do if you have a level 3 options that you can play the implied volatility crush on an earnings day, where you can trade the day before, and you're essentially selling, a straddle or a strangle, really close in the money, and essentially profiting the day after, depending on whether or not there's a huge move or not, which can go against you. So it's really risky, but it's a very short-term trade, and you can make quite a bit of money off of it. So all right, so covered calls. So let's go back to, so we kind of have an idea of, the range that we're trading. So trading anywhere from, really the range is between 50 and looks like 44. So, as long as we're somewhere around there, we should be okay. Looks like about anything above 47.50, 47.50 should be pretty good for us, pretty safe for us while we're doing this trading strategy. So we have this analyze tab. So, all right, so let's go back to March. I'll just use this here. Okay, so let's say March 5th. Look, we were trading at 51.29. So, all right, so we're going to look at the options chain, and I've already made a couple of these trades to kind of take a look to see what kind of profit we can generate from this, and it looks pretty good actually. So let's take our profit back trades back in time. We'll take them to the 5th. So, all right, so what do we want to look for when we are trading the covered call strategy? So within the option chain, we're looking for roughly 30 days out. Now, I started the first one on a kind of weird month. I wouldn't necessarily get into trading weekly contracts right off the bat. I would stick with the major monthly contracts, which all end on the 3rd Thursday of the month. So we'll want to take a look at, I'm going to just trade this March 16th contract. Even though it's 11 days out, there's enough value left in these that you can make a little bit of money in a short amount of time. So essentially we're trading like a weekly, and that's how these out of the money options are going to essentially work out. So when we are selling, we'll be selling a single option call. Essentially, there's the call side. Anything in this grayed out area up here is in the money. So you can see our strike prices we're trading at 51.29, and it looks like we're moving up in half in 50-cent intervals. So we can see here, where are we at? Okay, so the one major thing we want to look for is we want to stay about 30 delta away. So what does that mean? It pretty much puts us about 70% at a chance of being out of the money. So if you want to continuously generate just an income off of the strategy and you don't want to sell those shares, we want to be conservative, as conservative as possible. So close to 30 delta as possible is what we're looking for. And so the cool thing is that we're buying these contracts right after a huge dip in the price. So implied volatility is going crazy right now. So these contracts are actually priced a little bit higher than they normally would be, and we'll see that going forward as implied volatility goes down over the next couple months. So let's take a look here. So we're looking for as close to 30 as possible. So here we go. We've got the 53 delta, or I'm sorry, 53 strike price at a 0.28 delta. And those contracts are selling between 44 and 54 cents. And so we'll take the mid price, the mark of 49 cents, and we'll try to trade that. So if we can come down here, we'll take a look. Looks like we've been filled on these contracts. So let me get rid of those. So, all right, so we got filled at $53 at 49 cents. So let's move forward in time and see if the strategy worked out for us. So what we're looking for is the price to go essentially stay below $53. As long as we don't go above 53, we're doing good. So let us continue forward. All right, so we only have to go a couple days because we're looking for March 16th. So you can actually watch the P&L down here on the right-hand side. Oh, and I actually bought 500 shares of stock on the 5th as well at $51.29. So we have 500 shares. We're actually only trading 300 of those, these three contracts. I should back up and actually tell you how much, how the option price actually generates you money. So if we go back and take a look at the mark, let's go back to the 5th when we bought these contracts. So we bought them at 49 cents. Well, that's 49 cents times 100 contracts. So we bought 100. So that's 40, roughly $50 per contract. So we're looking at about $150 that we would collect immediately on March 5th to sell these options at 70% out of the money. That's the conversion. So we're taking in about 40 almost 50 $150 worth. So all right, so let's move on. So we're going to move up to, what's our strike? Expiration is the 16th. So on the 16th, our P&L that is open is $114.60. So what that means is that actually these contracts themselves are going to expire worthless that afternoon. So after trading is over, roughly I think about 7 o'clock, these contracts will be removed automatically from your account. You don't have to do anything. And you will keep the $150. 114 is just the price. That's just what the value of those contracts were at on the day of expiration. But you already collected that $150 in the beginning. Because you did not have your stock called away, you keep your premium. And then on the same afternoon, you're going to set your you're going to sell your next set of calls for the following month. All right. So if we come in here and we'll move up our time to the 16th. So we'll look at the next spread, which is the April 20th, which is about 35 days out. All right. So by that time, it looks like the stock moved. No, we're actually up. So we're up $490 on our 500 shares, and we've profited $150 on our option contract. So win-win. We'll see that doesn't actually doesn't work out all the time. Okay, so the next one is the April 20th expiration. And so I've done this ahead of time so it doesn't take us as much time. So we're looking at the no, that's not right. That couldn't have been the 47 because 47 is well in the money. So how did that happen? Ah, I see, because the trade date was wrong. So let's do this. We'll just do one live. All right, so let's take a look. We have about 35 days. You know why? I bet I know why that happened. Let's take a look. March. Yep, so that would have been the third Thursday. And the 16th is what we want to trade on. So Oh, I'm sorry. No, I didn't go far enough. So it's the 23rd. That's what we're looking for because we did that weird trade date. So okay, so we're actually looking at 28 days. All right, so let's go in here and we're going to look for a 30 delta. So we've got a 33 and a 22, so 33 is closer. It looks like we've got a 58 cents that we can sell these contracts for. So we'll go ahead and throw those in here. And we'll up that to the 3 contracts that we want to continue trading. All right, so we're looking at 23rd. All right, so we're on the 23rd. All right, so now we're looking to get to the 20th of April. So let's take a look and see what happens. So we'll move forward in time. And we've made it to the 20th of April. Bingo. Okay. So our strike is 46. Our final price was $46.23. So that would have been a bit of a nail biter if you were watching the whole time. It looks like our 46 almost finished in the money. So luckily we wouldn't have been assigned, but it would have been pretty close. So all right, so let's see here. What is our next? All right, looks like May 18th. So let's take a look at these contracts and get as close to 30 as we can. So we're looking at 25. That's about as close as we're going to get. So let's go ahead and sell another single. That brings us up to May 18th. And we sold those for 34 cents. So $34 times 3. Perfect. Okay, so let's move forward in time. Looking for May 18th. And it looks like we're going to profit. So we'll move forward in time. Go to May 18th. Perfect. So let's see. We had $48. It was our strike price, and we are well out of the money. Nothing to worry about there. So in just 3 months, we were able to take in, well, let's take a look. Grab my good old calculator here. All right, so the first contracts we did were 49 cents times 100 times 3. So that's $147. All right. Oh yeah, there. I'm sorry, the P&L's that we at the end there. So 147 plus 106 plus 104. $357 that we've collected now in the past 3 months. Now, that's great. I mean, we've made a bit of a return, especially since the fact that when we bought the stock, it was at $51. Well, we're now trading at 46. So that is life in the stock market. And we're currently realizing a $2,400 loss on our Oracle shares. But we're holding on to these long term. We believe that Oracle is an incredibly strong company and that it will prevail in the future. And unfortunately, 2018 was a pretty rough year for everybody. So just with those couple of weeks, we were able to make a pretty good return, especially in a market of quite a bit of turmoil. So let's see. I think we're going to, I think we're going to wrap up here. So we can take a look real quick at the chart and see. So this was kind of our price action along that time. So go back to the analyze section here. So we had our first strike was $53. So as we were looking through, we were well up here around this 53 level here. So we were well out of the money. No need to worry there. Our second was much lower at 46. So we look here, this was our second month. The market did move against us pretty well. We're at 46. Now, the one thing that you want to take into consideration is that it's not only is it $46 that we bought the strike price at, it's actually 46 plus the amount of premium that we collected. So it would be 40, seven. $46 and probably 26 cents, I think, was pretty close. 46. It was actually 46.50s, in the 46.50s range. So when you take a look at the stock, we did close almost we were 46.26. Well, our break even was at 46.50, so we still would have realized that gain. So very nice, but that was a very close one. And then our third month was also very close. So let's take a look. Yep, third month. So we were at 48. And we'll come in here and take a look at the chart. Actually, not too bad. So $48. Bring that down. It was close. That's close enough. So if we wanna, we can zoom in. That was rough. So we got our contracts back here on this date. Looks like the 18th. We were doing good, doing pretty good. And then the market started taking a turn up, and everything was looking pretty close. Like we were gonna have to call those away. But then at the last second, the market moved down, it gapped down again in our favor, and we were able to keep that full premium, which is really cool. So a nice thing to see there. So I guess we can talk about, have a couple more minutes. So we can talk about what would have happened if if those shares were called away. So we could buy back those shares immediately, and you'd buy them back. You'd be buying shares at a pretty low price compared to what we had bought them at. So we had bought originally at about $51. Well, we're trading down in the $45 range. So really, I mean, you were called away. You realized, that gap of a loss. So, but we can regain some of that by buying back around in the $45 range while it's trading there, and then holding for the long term and seeing how that works out for you. So. And then if we had gone forward for the next month, actually, incredibly, Oracle had another mini gap down, which would have worked out in our favor for this trade. Yeah, it was actually it was a pretty big gap down. So, but this would have probably worked out. We would have been in here. We would have been about 2 strikes up, so about the $49 range, and we would have closed out under $49. So you can deploy the strategy as frequently or infrequently as you want. It makes a lot of sense if you want to generate a bit of a revenue, a dividend that you can just reinvest back into the stock that you're currently holding on to, or use to build a new position. So, all right. Well, thank you for joining, and I've recorded this whole meeting. So, if you would like to come back, ask any questions, please feel free to send an email to zach@milcorentals.com. And I'd be happy to answer any of the questions you might have, and hopefully you'll be able to just deploy the strategy and generate a little profit off of it. So, all right, thanks again for joining, and I hope everybody has a great day.